Hi everyone, this is Andy giving you another update. Not really in real time, but more of just a discussion on different assets than say platinum and whatnot. So let's just jump right into it. So I've got a picture of gold here, and one of the attributes of gold and precious metals just in general is that when you see it and when you look at it, it just looks so inviting, so like I gotta have it. So I have this picture up here just to show you kind of that it looks so great. And another thing to think of is, we went through the entire periodic table, and what we found, throughout all these years, and I know many things have been used as currency, but the couple that have really lasted with human beings has been gold and silver. And I've got a picture here of silver as well, and it's just like, man, that looks pretty fun to stack. It looks amazing, and when you get it in your hands, you just want to have more of it. So yeah, I mean, these two are what humans have chosen that's been available on Earth. And I want you to think about that for a little while, and then also to think about, we have all this man-made currency, bonds, stocks. All these things are man-made, and really there's only a few forms of wealth or wealth preservation out there, and those three things, at least according to Jim Rickards, and I agree with it, is precious metals, real estate, and fine art. Those are the three. And when you think of it, you've got humans that have selected, they basically went through the entire periodic table and came up with these two things to use as money, which is, gold and silver. I mean, just think of all of the other assets out there and all of the value that are tied up in those assets. Now, if those assets haven't lasted the test of time, when they do fail, where's all that wealth going to go? And I think it's going to go to those three asset classes. It's art, which is kind of like the history of humans, if you think of it in that perspective. You've got real estate, so a lot of money is going to flow towards real estate. And then you're going to have a lot of money going towards precious metals, I think. So when you think about the current situation that we're in, and you're trying to look at different assets and where to deploy your money, I think you have to think of, what are things that are naturally going up? What are the cycles that are in favor right now, and what are cycles out of favor? So if you look at the Federal Reserve, what are they trying to do? They're trying to prop up a stock market. So I think stocks naturally want to fall. You've got a bond market where you've got interest rates that were in a 40-year decline, which was basically a 40-year bull market in bonds. So they're trying to prop up bond markets, trying to prop up stock markets. They're trying to prop up paper assets. And then further on in the slide, I'm going to talk a little bit about real estate. And real estate, I mean, just look at this. Come on, like, you look at this and you say, I want to live there. Who doesn't want to live there, right? I mean, that just naturally, it's like, that is a pretty awesome house. And you're overlooking, the ocean and mountains, and it just looks gorgeous. And I'll get into that cycle, of the real estate cycle, and where I think that is. And then also precious metals. Now, here's another thing that I want to talk about. Here's another asset that a lot of people are pretty big on, Bitcoin. And the only thing I'm going to say is, look at that picture and look at it and kind of pick it apart. Why did they choose a gold coin? Why are they choosing coins at all? Why do they call it Bitcoin? Why did they go about choosing mining for Bitcoins? How do you value Bitcoin? There's so many questions about it, and I'm not a huge proponent of it, at least not yet, because those are some of the concerns I have. And I'll talk a little bit later in this video about a little bit about Bitcoin and my thoughts on it. So this is touching back up. I talked about this in the previous clip, is Dow to gold, 100 years. This is that ratio. And again, cheap is Dow, cheap up here is gold. And right now we are cheap gold on declining, which means gold is moving, is making purchasing power gains against the Dow. So that cycle is gold positive. I just wanted to reiterate that. So another thing to think of is just how much gold and how much silver are left in the Earth's crust. I mean, how much is out there? And I was looking online, and this is, someone born in 2010, how much is left for these people. And they've got kind of, how much is in reserves and maybe other reserves that are out there. But if you just look at it from a high level, and, obviously this is reserves. It doesn't mean that reserves are necessarily the production rate. The rate will obviously slow down as the ore grades or as something becomes harder to extract. And even if technology overcomes that for a short period of time, eventually you will extract it faster, which means that you just hit the end of whatever that reserve is quicker. But if you look at the bottom of this chart, you've got silver here and gold. And what's kind of crazy, and I don't know how accurate this information on this website necessarily is, but I'm sure it's somewhat accurate. But if you look at silver and you just look out, I mean, they're saying we're really only going to hit like 2032. And that's really not that far away. 12 years, 13 years. And then you've got gold too. And then you've got I think gold's already, the production is already in decline. And silver, you could say the same thing with silver, that the production's in decline. So not only do you have a cycle where gold or precious metals in general are in favor, which means they're going to make purchasing power gains against stocks, you also have in the backdrop this reserves that are declining and production that's declining, where everything's kind of moving in this geometric scale upward in terms of demand, with the reserves declining quite rapidly. So we don't have that much stuff left. We don't have a lot of silver left in this earth crust. We might at very low grades, but you got to keep in mind, though, it's going to take a lot of energy to extract all that and a lot of time. So the production rates may not be as high as some of our earlier production rates. So I think that's something to take into consideration. And another thing to take into consideration is, they're creating currency at a pretty fast rate. It's in trillions, and they're fighting deflation. They're fighting deflation with a bunch of inflation, and I don't know how successful they've done. Has been at fighting deflation in the past, but they basically have come out and said we're gonna flat out print, and we're gonna hold rates to zero, and we're gonna print, and if inflation goes above 2%, whatever. That's kind of their take on it. So, keep that in the backdrop, of your mind. We're in a precious metals bull market. There's not a ton of this stuff left. We're in a production decline, so production's going to it's going to be very tough to increase production of it. And we've got currency that's a tailwind behind us. And here's another chart just saying, this is the years left at a sustained 2% annual primary production growth based on current reserves. And if you look at the left-hand side, hopefully you guys know your periodic table, but AG is silver, AU is gold, less than 15 years. And this is from a different site. So, I mean, it's got to be somewhat close to that other slide that I had. So either way, let's just say there's less than 20 years, and 20 years, that's 2040. So yeah, I just wanted to show that. I thought that was a kind of cool chart. And I also want to talk about, asset manipulation. So what I mean by that is, what is the Federal Reserve trying to do? What are they trying to prop up? I mean, what are they trying to stop? And it seems like everything that they're trying to stop is stocks and bonds from collapsing, but mainly stocks. And, you know, if we look at real estate, so I'm going to back up a little bit. We had a real estate oversupply situation where we put out a bunch of bad loans. We were just loaning to everybody, at least the United States. And that created a huge bubble. That was in the mid 2000s era. That bubble is probably going to create a much larger bubble in the future. And I'm going to go through that and explain that. So that bubble, we had massive amounts of foreclosures. And what that did is it kind of destroyed the home building, the new home builds. That market got destroyed during that time period. A lot of people got laid off. They went from building 2 million homes per year, which is an overbuilt situation, and then you had all the foreclosures come on. So we had all these new homes, all these new foreclosures. They all came on at once, and that industry, the new home builders, really had to contract during that time frame in 07, 08, and 09. That kind of top peak, and then that contraction right after. So now, if you kind of fast forward, those banks that took on all those foreclosures, they had to slowly get rid of those foreclosures over time. And the builders, the new home builders, were not building many new homes. It went from 2 million down to like 400,000 or 500,000, something very low. And it did that for many years because we had so many foreclosures. And what that set up was we had a very low housing market. If you looked at the housing market from any sort of metric perspective, it drove house prices down quite a bit. And they stayed down for quite a long time. Quite a long time being, 08 all the way to 2015-ish, 2014-ish, where things didn't really move upwards that much. Now, during that time frame, they were offloading all of the foreclosures and selling them into the market. Eventually, you're going to run out of foreclosures. And the new home builders were not building homes at the rate of the demand that was out there. So say the demand's around 1.2 to 1.5 million homes per year. They're producing around 500,000 and slowly increasing above that. So we're getting into an underbuilt scenario after those foreclosures were sold completely off. Because then when those foreclosures are completely sold off, you're going to have to go to new homes being built to make up that difference between whatever the market turnover rate is, and then the new homes are going to have to make up that entire difference of new demand that's out there. So it set us up for a situation where right now we're about 4 million plus homes underbuilt nationwide. 4 million. The entire market demand in per year, I think, is around 1.2 to 1.6 million. It's somewhere in that range, depending on where you look at. And I mean, you're talking about a few years worth. That means that the new home builders are going to have to build not just 1.6 million new homes, but they're going to have to build all the way up above it for a good length of time to catch back up this cycle. And this cycle, we're in the middle of an uptrend cycle. If you look at most cycles, they're like about 20 years, down kind of 10-ish, up kind of 10-ish. So if the market tops, 2006, we might go out to 2026, 2027. That might be a market top. And if you look at it from a perspective, the Fed is trying to prop up the stock market. They're not trying to prop up the real estate market. So we're in the middle of a boom. We're 4 million homes underbuilt. We're in the middle of an uptrend cycle, and prices really just started to start moving because they really move at the end of the cycle. They go kind of vertical. So we're just getting heated up right now. And the Fed just lowered rates and is printing a ton of money in the middle of a real estate uptrend cycle. This is fuel to a fire here. I think real estate's an excellent spot to be in because we're underbuilt. And we're in the middle of the uptrend cycle. And we have low interest rates. Now, another thing to think of is interest rates, they don't go low at a bottom of a real estate market. They are typically extremely high because interest rates chase inflation, so to speak. They try to slow the money velocity down. So they try to capture that money in investments like bonds. So if you look at real estate, I don't think we're at a top. I think we're just, I think we're just getting moving on some really ridiculous moves in real estate here. And the things to look at to see if the real estate market and how COVID has impacted the real estate market, because we're in the middle of an uptrend, and I don't know necessarily how COVID's gonna affect this, but the things to look at to evaluate the real estate market are days on the market, inventory. You want to look at prices, obviously, interest rates, and foreclosures. And right now, all of those metrics, we have very low foreclosures, very low interest rates. Prices are increasing. We have zero, like there's hardly any inventory out there. This may be the lowest we've ever had. And days on the market is literally, you could exchange that to maybe even hours on the market for some cases, depending on the house price. And especially here in Colorado Springs where I'm at, I mean, they're flying off. They come up on a website and it's like, they just come up pending almost. So I don't even know how some of these people are getting these homes. So I think real estate's going up. And if you look at the precious metal cycles, precious metals, they really move on inflation as well, deflation and inflation. So if we do have inflation, and we should be looking at those metrics for inflation, we should be looking at the 10-year Treasury bond and seeing which direction that's going. If it's going up, it's probably more inflationary measures. If it's going down, it's more deflationary, and it's gone down quite a bit, which means that we had a deflationary kind of bust. But the Fed maybe they succeed in getting their inflation that they want, and maybe it goes out of control. But I think real estate is a good spot to be in, and I would look at those metrics to see the current state of real estate. And I also want to make some comments on Bitcoin, because I know a lot of people, they want to go into Bitcoin or alternative coins or cryptocurrencies. My question is, how do you value it? How do you know you're getting a good value? How do you know you're getting a good price? How do you know you're in the right cryptocurrency? And I'm obviously not an expert on any of these coins, but I also don't think anyone else is. It's just all a bunch of opinions. There's no way to really value it. And if you can't value something, I don't know how you go on and can hold it and be comfortable with it. And here's another question. I know that in most of these alternative coins, you can limit the amount of coins that can be mined, and just, it's great. They all look like coins. They make them the same color as gold and silver. They call them mining. They make it all the same as the real stuff, we'll call it. But how many different altcoins can be created? An infinite amount, correct? So what is there to limit? I mean, you could limit each one of them. You can limit how many Bitcoin, how many Ethereum, how many Neo, or whatever else there is, but you can't limit the number that's created in terms of each one of those, different makes, so to speak. And my question is, what is it? What if it's just one big fake? Like what if it's just there to enrich the people that created it? I mean, that's kind of what a paper money, paper currency is, right? It's just there to enrich the person who owns the creation of that currency. And why would this be any different? I don't know. Another thing to think of is, it's pretty awesome that they created this blockchain technology, and maybe it's Hashgraph and something else that's next or whatnot. But one thing to think of is, what if the Federal Reserve takes all this technology, which is all tracked and controlled almost. It's supposed to be not controlled. What I'm saying is, what if they can control it? What if they can control every transaction and see every transaction in the system? What if they took all that good technology and used it to their benefit? And I have a feeling that may even happen. But nonetheless, I mean, for thousands of years, we have chosen off the periodic table, off of everything that we have on this earth and in this universe, as we know, have chosen gold and silver, and obviously the other precious metals are just so rare that they can't perform the function of being plentiful enough for trade, but I also think that those are good alternatives to put money in, which is platinum, palladium, and rhodium. And if you think, there's another thing I want to talk about kind of at the end here is, if we have a shortage in something, let's say everything's kind of is dealt on the margin. So it's very few people at that last end that's really going to drive price. And what I mean by that is, let's say you have silver, and then eventually you're going to, if they have been manipulating the market, if they have been holding prices down, let's say you run into a shortage scenario. Investors, they make up only, a few percent, and they go and they buy these metals. And then metals, let's just say the investor percentage starts growing, a few percent turns into 10% or something like that of the total demand. And then we run into a shortage. What are the investors' reaction to that shortage? They're going to say, crap, I better buy as much as I can. Well, you have to keep in mind that some of these metals they have industrial uses. What do you think the industrial demand and those users, what do you think their reaction is going to be when they start seeing shortages? I mean, what the heck are they going to do? Are they going to just say, I don't care what the price is, go buy as much as you possibly can? We can't stop production. I don't know. I mean, you get in a scenario where you start thinking, a few years ahead or 3 years ahead, or maybe it's only months ahead. I'm not exactly sure. But what happens if any of these industrial users get scared? Are they just going to buy it all? Are they going to say, screw it, buy as much as you can whenever you can, and start making contracts with miners and whatnot? I don't know. That's one thing to think of. And having the physical metal, I think, is the lowest risk way to play this, because you have zero risk in terms of mining companies that get taken over by governments. You have zero risk in terms of share dilution and buying something that has a company that has bad management that really messes everything up. But I'm not saying to not buy any miners. I'm just saying the lowest risk way to play this, I think, is to buy the physical metal. So that's all I had for this clip today. I really appreciate everyone who's listening to this. I hope that my ideas and thoughts help you in your investing decisions. And if you like what you hear, please subscribe. I'm going to be creating a whole bunch of different videos, very similar to these, and eventually start giving updates on market news. So thank you.